Welcome to the Tax EndGame with Mark Kanakaris from Cherokee Tax Group. As an advanced tax strategist and enrolled agent licensed by the Internal Revenue Service, Mark is uniquely qualified to go deeper into the revenue codes than most accountants. He understands and interprets the provisions on how you can legally save on your personal, trust, and estate taxes. Now you can reroute those wasted tax dollars. Mark provides business owners, professionals, and individuals the guidance they need to prepare their taxes today for better tax planning tomorrow. Using a solutions-driven and unique holistic approach, Mark breaks down the loopholes around tax planning and preparation along with must-know financial planning and tax reduction techniques. Listen in as we tell you what no one is going to tell you about taxes. Now, on to the show.
You're saving for retirement. After all, you have an IRA, and that's great. Is it a Roth IRA? What's the difference? And suppose your account is not a Roth. Can or should you convert what you have? Well, Mark Kanakaris is here to help you understand the Roth IRA. I'm Patrice Sikora. Mark, let's first hit on the basics, all right? Like, what is the difference between your traditional IRA and a Roth IRA?
All right. Well, great question to start. Really it has to do with the taxability when it comes out. So both of these are a deferred account. It means you put money in no matter whether it goes up or goes down. There's no current taxes on your current year's tax return. But when you do pull it out, there can or will be taxes. So a traditional IRA, which is what most people have, it's your 401ks, your 403bs, maybe you have a TSA or if you're a federal employee, you have one of the federal plans. And when that money all comes out is 100% taxable at your current tax rate. The Roth account comes out after it's been seasoned for 5 years, totally untaxable, tax-free to you. And there's so many other benefits to the Roth. We're going to make sure we cover all that today.
But now, wait a minute.
Basic things.
You said when it comes out of the Roth, it's not taxable. So where do you pay your taxes for a Roth?
Absolutely. You're going to pay them up front when you put the money into the account. Now, it's interesting. You can pay money once, or you can I guess you always pay it once. So if you're working and let's say you have an extra $1,000, let's say you get a bonus, you have $1,000. You've already paid the taxes through your W-2. You put it into your Roth, and after 5 years, it's totally untaxable, everything that comes out. If you have a traditional IRA, and we'll talk a lot about this today, you have to do a Roth conversion, which means you have to take it out of the traditional IRA, pay the taxes at your current tax rate, and then put it into the Roth.
All right, you're talking tax rate now versus tax rate later. Isn't the prevailing thought, when I'm retired, my tax rate will be lower?
My gosh, there's a couple of common misconceptions that people thought when they retired. When they retire, they're going to need less income. They're going to be in a lower tax bracket. They're not going to need as much money because they're retired. Well, all of that is totally wrong. If you think about it, first of all, when it comes to taxes, what are your biggest deductions on your tax return? Well, it's simple. It's your home, it's your IRA contributions, and it's the kids. Well, when you retire, hopefully the kids have moved out and taken the dog. You're not putting money in a 401k, you're taking it out and your home's paid for. You have no deductions. Most people retire with no deductions at all.
Oh.
So the whole idea of you retiring in a total tax bracket, garbage. Now, no one's ever walked into my office and said, Mark, I can't wait to retire on 30% of the income I have today. Everybody wants to retire on the income they have today. So spending did not drop. Because I always say, remember, in retirement, every day is Saturday. And the whole idea of investing that you could pull 4% out of your investments and you're going to live forever and never lose, you're going to touch your principal, that's garbage too. That's totally out the door. The financial planners have had it wrong for 30 years. And now the rooster's coming home to roost. And people, if they don't properly plan for retirement, they're going to wind up broke.
All right.
Now, I'm a betting man and I'll take the odds and I'm pretty sure I'm going to win that bet.
Mm-hmm. So you're talking about the Roth. Let's get back to that. Can anyone contribute to a Roth? And are there limits to what you can contribute?
Absolutely. So the limit contributions for Roth this year, if you're over 50, is $7,000, and is expected to be the same for 2022. Now, you can only contribute to a Roth if you have earned income. So you can't have dividends and interest from the bank and Roth. That doesn't work. Not as far as contributing, converting, totally different story. And of course, if you don't make $7,000, you can't contribute $7,000. You can only contribute what you have in earned income. So if you have a part-time job, you made $4,300, well, that's what you can put in. That's it. And some high income earners can't put anything in at all.
Why?
I guess the government wants to get you one way or another, but they have to do backdoor Roth conversions and stuff like that.
All right. What's the limit on the upper income level?
Oh, great question. I'd have to look it up. I don't keep that number to memory. Hold on. Let me think for a minute. I think you have to have, if you're married filing joint and you have under 198,000, that will be the limit. If you are single, it's less than 125,000. All of those can contribute over those amounts. AGI, right? Not gross income, AGI, those are going to be your limits. Anything over that, you cannot put into a Roth. Those people will do the back door.
If you have a traditional IRA, can you convert the entire thing?
Absolutely. But you better have a really good tax planner like myself, or you will get hammered in taxes. So I always say, when it comes to Roth conversion, it's a process. You're going to do it over time, not take it right away. One of the biggest problems that people, let's just take somebody who doesn't even need the money from an IRA, and they have $1 million and they're retiring, they could pay almost $1 million in taxes over their lifetime. They haven't even made $1 million yet. I mean, that's the taxes due over the lifetime. If they take that money and reinvested it and just pay taxes on it every year, that it could be a real detriment. Mm-hmm. If you can cut that into, you can pay 20 cents in the dollar over the long run if you Roth convert over a pretty aggressive 5 to 10 year period. There's real savings. It's real money. It's not a couple of bucks here or there.
What does it take to convert?
Nothing. You just got to go and talk to your accountant or tax planner and say, I want to convert, and then come up with a plan of how to do it. And then, of course, you can either pay the tax out of pocket, you could pay it out of the Roth conversion, or maybe you do other not charitable stuff, but there's charitable trusts you can do, or other trusts you can use to defer or deflect some of those taxes for the future, or just reduce them altogether, or you just buy tax deductions. We talked about some of those misconceptions about Roth. Mm-hmm. A lot of people, they come in and they go, well, great. How much does a Roth make? So I always want to say Roth is something you do. You're going to take money out of your traditional IRA. You're going to pay the taxes. You're going to put it in a Roth. You can invest that Roth IRA in anything you want. You can buy stocks, bonds, mutual funds. You can go buy rental property. Anything you're legally allowed to do in your traditional IRA, you can do in your Roth. A lot of people think it's an investment in and of itself. Oh, do you have a Roth IRA? No. What does that make? Well, it makes whatever you invested in. Mm-hmm. So that's a very big misconception that a lot of people, I hear it all the time. Probably 60% of my clients, when I say you need to Roth, they go, great. How much does that make? I'm like, it's not what it makes, it's what it does. And it can make what you want. You're going back to the back door Roth conversion. And that is something that we do a lot for high income earners. And basically, there's no real magic. Just what they'll do is they'll go in and they'll put $20,000 into their IRA, and they'll just turn on and Roth it in the same year. So they'll get a deduction and they'll pay the taxes. So it's really a wash, but they get it out of the traditional into the Roth IRA. And there's no real limits. And there's no limit to Roth. You can Roth until the day you die. Everybody thinks, well, I can't. Yes, you can only contribute while you have income, but you can Roth convert forever. And the real benefit is going to usually be to you later on in life, or to your spouse, or to your kids who inherit it, because people don't realize their biggest beneficiary, if they don't Roth convert their money, is going to be the IRS.
So you can convert even if you're in your 70s?
80s and 90s. And I got clients in their 80s still Roth converting.
Why did they wait so long? Why did they wait? Nobody
told them. Not a lot of people have met a tax planner that showed them. Like, we have a really great report we show to all of our clients and potential clients. And it just says, look, here's a rough ballpark of how much taxes you'll pay if you don't Roth convert. And I was sitting with a client yesterday, and we'll call her Judy. And Judy's a really nice lady. And she says, man, when I saw that report, I didn't realize in just my $360,000, I'm going to pay almost that much in taxes. But I even need the money. I says, well, you can keep a lot more of it if you start Roth converting now. So you'd think, well, how much did you Roth convert? Well, we only did 19,000 because that was what the tax bracket would absorb without jumping to a whole new tax bracket. Because I'm pretty sure if I can Roth the bulk of this now, she'll never leave her 22% tax bracket until the tax brackets change to the Trump provisions, the sunset provisions expire, and she'll be forced at 24% anyway, but at least she did it at 22%. She's still coming out ahead.
Which, I mean, that raises the question again, why don't people do this? You say they don't know about it. Do employers offer these?
Some offer. I've talked to clients that say they have a Roth IRA at work they can donate into, but the problem is accountants, it's just not their business model. Just like financial guys, their business model isn't to be holistic. It's just to sell whatever they're told to do. But when you go to accounting school, you do taxes for income, but the money's made in consulting and doing books for big companies. They don't realize as I realize, I'm better off being a tax and financial guy, and I can do so much more for my clients than just being a tax guy. Because tax guys, let's be honest, are a dime a dozen. Anybody can recite rules. It's using those rules to your advantage and showing them the things that they're missing. And I have a client right now that would Roth $36,000 a year for the next 5 years. Their whole IRA will be Roth, and they're not going to pay a dime in taxes to do it. How's that for crazy?
That's really crazy. That's a great crazy.
Sure is. I actually have a multimillionaire who's Roth converting for almost free as well. He'll never Roth convert because it's just too much money, but we're Roth converting almost $36,000 a year for him as well. And he's paying no taxes as well. And this is a guy with millions of dollars because we be able to structure his income in a way that we limit where he gets taxed.
I'm just sitting here going, oh my, goodness gracious.
This guy was an executive vice president for a big company that everyone has heard of. They sell coffee in every corner, and it's just incredible what we've shown him. And this is a guy, I was shocked that a guy at this stature and this kind of wealth has not been talking to guys like me and lawyers that do what I do and showing him all these opportunities. It's just nobody talks about it because maybe it's just not their business model. But tax planning, if you don't do it, you're just going to succumb to the laws that are out there, and the IRS is going to rob you blind. And you're letting them do it.
Talk to me again about the tax wise. Before you retire, you're in one tax bracket. When you do retire, hopefully you're in a better tax bracket, but maybe not. How do you figure out, should you do it now? Should you wait?
9 times out of 10, because of your income, you're going to wait till you retire because you are going to drop some income. Most people don't retire right at the income they've always had. It's going to drop 10 or 20,000. And most people are okay with that. They understand they're not working and they've saved well. So usually when they've dropped that tax bracket, and you can control when you turn on Social Security, I've got more control over your tax bracket outside of tax season than I do inside of tax season. So that's why I prefer to do it when they retire. But like the lady that was here yesterday, she still works. We're just Rothing within her tax bracket. And again, I already know when she does retire, she'll just be at the bottom end of her tax bracket so we can Roth even more. So we do futuristic, if you will, or we forecast our clients' tax returns. We create actual tax returns with their future income and see what it's going to look like. And I can show somebody and say, hey, Patrice, when you retire, here's what your basic tax return. I'll call it the baseline tax return. This is before IRAs, 401ks. This is just Social Security and your pension. Here's your base income as a single person or a married couple. Here's what your base return looks like. Here's your tax bracket. And then we do an RMD worksheet that says when you hit 72, here's minimum taxes that you're going to have to take out of your tax return, whether you like it or not. You're going to be forced out at 72. And the sad thing is not only being forced money out at age 72, but it's more than what the professionals say you should withdraw from your IRAs to avoid, running out of money before you run out of life.
Oh, that 4%.
That's another whole problem. That 4% rule has been proven by Wall Street Journal and Morningstar.com to be wrong.
When people come to you and they figure out, oh, I'm going to be taking just 4%, and you show this to them, how do they respond?
They usually look at you like, well, what do we do now? It's not that you can't pull out 4%. You have to have the right tools to pull it from. I kind of say there's a right way and a wrong way to retire. You use the right tools, you'll be fine. You use the wrong tools, I hope you have a good tent. Or I hope you enjoy living with the kids. Now, don't get it wrong. I get it. If I lived to be 95 years old, I hope my sons would take me in to take care of me at some point. I get that part. If you don't plan, you're in trouble. Those who fail to plan to fail. It's still true today.
Is there anything about the Roth that we haven't covered, or you want to go back and do more in depth?
Oh, gosh. When it comes to Roth conversion, I think people just miss the uber importance of doing a Roth conversion. A lot of people come back to me and say, well, gee, what if I die tomorrow? Doesn't matter. Your money's still going to be here and somebody else is going to have to deal with it. So I kind of say that's a garbage answer. If you don't do it, you're just telling the IRS, hey, I don't care how much in taxes I pay. Come get as much as you like. I mean, Who would it make a deal with? If I said, Patricia, I'm going to give you a loan and you don't have to pay, I'll tell you when you have to pay it back and I'll tell you what interest rate you'll pay it back when I want the money back. You wouldn't take that loan. You'd be like, I'm out of here. That's a stupid loan. You could come back and ask for 85%. Well, that's what we're doing with the IRS. They don't have to really change the laws dramatically to increase taxes. They could just remove deductions, stop making increases to the tax bracket and just leave them stay. And eventually over time, people in inflation, people will make more money. They'll pay more taxes. I mean, the rules are against you, but you have the rules to use. You got to find somebody who understands the rules. And I even tell some of my clients, I may not Roth convert all of your money over your lifetime, but if I can Roth convert the bulk of it, I'm happy with that. Because my goal would be from a spending idea to spend your IRA money that we're not going to Roth convert. Maybe in your late 80s and 90s, all you're taking out is tax-free money. And I'm okay winning that way. I just don't want to leave. I tell people, if you were my mom or dad, I don't want to inherit your $200,000 IRA. I want your $200,000 Roth, because out of the $200,000 IRA, I'm going to keep about 120. I'm not in the 120. I want to keep up 200. And you didn't save 200 to give me 120. There's not a discount at death. So let's make it where everybody can win. Because if you give it to me, I got to add it to my income. And gosh, now I only have 10 years. Let's even go down that road. When kids receive inheritance from their parents, they want to cash it in usually right away. If you have some Roth money for them to inherit, hopefully they're a good account and say, hey, you don't have to take the rest of the money right away. Here's some money now. Go pay down the house or buy a new car or pay off your debt. Take this out properly within your tax bracket. And now you can really win. You have to help your kids against themselves. No matter how smart you think they are, you have no idea what their life's going to look like when time comes that you go. Everybody comes in here every day, tells me how wonderful their kids are. Then all of a sudden I meet some of these kids because mom's gone. You're like, this guy's a bum. This guy's no winner. Mom said all these wonderful things. He's in trouble, coming and going. So she really left him in a bad place. But the ones that do it, the kids, when they get that Roth money first, I can sit there and say, okay, look, you're all getting 100,000. Cool. Now you got to get another couple 100,000 a piece, but you got to take that over so many years. You can work with me, work with your tax guy, and just say, you want to pull out whatever you want to pull out at a way that makes sense tax-wise. Or the parents, they can go set up a trust and say the trust gets the IRA and the kids have to take out 10% a year until the last year. And at the last year, they pull the rest out to make sure the kids don't screw themselves up. That's another way to go. I don't see it happen very often. Most of my clients don't do it. They'll just Roth convert it and make it easier for the kids. The skip generation thing that was out there where you could bypass your kids and go right to the grandkids is gone, where they didn't have to pay the taxes on. That was a wonderful thing. That's gone. So there really is no advantage to trying to say, well, I'm just going to get my kids and give it to my grandkids. Yeah, if they get it at 5 and don't mind doing a separate return, they could probably save a few bucks in taxes, but it's not really worth going through all of that complexities, if you will.
All right. Well, Mark, how can people reach you? Because you've answered a lot of questions here, but I'm sure people are sitting back going, what does it mean for me? And you really need to talk right to them. How can they reach you? Yeah,
they can always call me at the office, 678-981-6331. Email me, Mark.K at CherokeeTaxGroup.com. Just call and get a free consultation. We have a secure cloud. They can send us anywhere in the country or the world. I guess you can send me your tax return. We can look at it online together and do a Zoom call if needed, or you can come into the office. We've got clients all over the country now, almost coast. I think we're coast to coast now. I think we just picked up our first Californian. That was another joke that I'll pass on that. But we have our first Californian, and we were just talking about their tax return. And unfortunately, we can't do much when it comes to the state because the California tax code is about as complicated as the IRS tax code. But on the federal side, we're able to help there. Just a last minute thing that I forgot to talk about with taxes. With a lot of people don't forget, when you do Roth conversions, you need to be careful because sometimes you could get hit by your state, depending on the state, depending on how much you Roth convert. And that's something that we talk to our clients when we do Roth conversions. We want to make sure we get the state out of there as well. And this, another side benefit is eventually, if you were to Roth convert everything, in theory, you may not pay taxes on your Social Security, which people don't realize they can be taxed up to 85%, caused usually by their IRA. I hate to say it, the worst people in most people's lives is their financial advisor because they just don't understand. Mm-hmm. And even if the accountant did his job and told them what to do, most tax guys just don't do that to begin with. So it's really tough for retirees to really get ahead in this game without the proper tax and financial guy like myself to solve those problems for them.
So they should make sure they start talking to you before they retire.
Oh, yeah. Yeah. Because one of the things I would say, you need to prep for retirement financially. And then when you're in there, you already have to have a tax plan that's already in place. Because for most people, when they're retiring, I have a pretty good idea. No one ever really retires on time for some reason. If you said, gee, Mark, I'm going to retire at 66. Yeah, I'll take a bet that it's either 65 or 68 because no one retires on time. I mean, if you have I have a guy now, he could retire tomorrow. He's like, Mark, but I make $200,000 a year to sit at home. Hey, man, keep working. Because I'm not really working though. I was like, I know, but pretend you're still working. I mean, why give up that kind of great income? He's an engineer at Lockheed. Might as well keep working. There's no reason to like retire. I mean, you're not doing much more retired. Wife travels half the time taking care of your 3 girls. So what do you care? Keep working and bringing the money. But when you do retire, that guy can't Roth convert. He's in a super high tax bracket. But when he retires, that income's going to cut in half. He can have more income. Obviously, you could still have $200,000 a year, but they don't spend at that kind of level that I think they would spend that kind of money. But for them, with kids who are going to inherit that money, they've got to Roth convert. And if you don't, sometimes it could force you into other estate issues.
Like what?
Or if you have more than $5 million or $10 million between you and your spouse, now your kids can pay federal estate taxes when they pass away. So I have a guy now, I says, look, if you save even fairly decently, you're going to have an estate problem when you and your wife gone. You need to Roth convert now and maybe even do some irrevocable trusts. But that's another conversation. That's really an advanced tax plan for high net worth folks. We could do that for another show, though.
Sounds like an idea to me. All right, so now you know there are IRAs and there are Roth IRAs, and Mark Kanakaris of the Cherokee Tax Group can help you understand them all. Follow the Tax EndGame to know where new episodes of the podcast are ready, and don't forget to share with friends and colleagues. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to the Tax EndGame with Mark Kanakaris, the podcast that shows you how to win the tax game. Have questions about topics covered during the show? Visit www.CherokeeTaxGroup.com. Email us at info@CherokeeTaxGroup.com or email Mark directly at Mark.K @CherokeeTaxGroup.com. You can also call us at 678-981-6331 to set up a free consultation. Don't forget to click the follow button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and or guests and does not necessarily represent the views or opinions of Cherokee Tax Group. The content has been made available for information and educational purposes only. The content is not intended to be a substitute for professional tax advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your individual situation.